This is Luckin Coffee. A server pours a small amount of orange juice into a cup, adds a bit of water, stirs it, and then puts in some ice. Finally, they add a shot of espresso, and voila, a cup of orange tea Americano is ready. Next, they pour some grape juice into a cup, add a little water, stir, add ice, and a splash of coffee. That's the grape cold brew Americano. Other drinks like grapefruit tea Americano, orange tea iced tea, tiramisu love latte, or coconut cold brew latte follow similar methods. Some customers skip the coffee entirely, opting for just juice, water, ice, and milk. These simple recipes cost Luckin only 2 to 3 RMB to make, but they sell them for 9.9 RMB. Some online users even think that 9.9 RMB is a bit pricey. Yet, in today's climate of economic belt-tightening, this affordable 9.9 RMB coffee has become a hit among young people. Luckin's low-price strategy has quickly taken over China's coffee market, overshadowing Starbucks. Recently, there's been talk in the market that Starbucks might sell part of its business in China. Once a symbol of premium coffee culture, Starbucks now faces the harsh reality of losing ground.
星巴克都想退出中国市场，想要变卖中国区的业务。
Even Starbucks is considering leaving the Chinese market, looking to sell its operations there. Luckin's rapid rise has sunk many coffee businesses, and even Starbucks is struggling. So, if you're in the coffee industry, don't beat yourself up. If Starbucks is taking a hit, what chance does anyone else have? From profit margins to the average customer spend, everyone is under massive pressure. Now, Starbucks has resorted to things it never wanted to do. Live streaming and group discounts, selling coffee for as little as 10 RMB a cup. But let's think about this. If Starbucks really fails, will it be a good thing for consumers? Without Starbucks, leading coffee brands might start raising prices again.
Some bloggers say Starbucks leaving China was only a matter of time. Back in October 2023, Starbucks ran a promotion on a popular app where single cups were discounted to as low as 20 RMB. People in the fast-moving consumer goods industry know the golden rule of price perception. Brands must use bundling or combo discounts to obscure the true cost of individual items. That's why Starbucks initially only offered multi-cup bundles or coffee paired with breakfast. It confused customers about how much a single cup actually cost. But the moment Starbucks began offering single-cup discounts, they exposed themselves. It was a sign of complete defeat. They must have known this would harm their brand value, undermining the 30 RMB per cup price standard they had set. Direct price cuts are never a good move. They erode a brand's value. China is Starbucks' second largest market after the US. Over the past few years, the company has faced fierce competition from local and international brands, especially Luckin Coffee. According to sources, Starbucks has informally gauged interest from potential investors, including Chinese private equity firms. Insiders suggest that selling a stake in Starbucks China might attract interest from local corporations or companies experienced in the industry. However, no final decisions have been made, as Starbucks is still weighing its options. Starbucks is also under pressure from Elliott Investment Management, one of its largest investors. Elliott is urging the company to reevaluate its China strategy. In response, a Starbucks global spokesperson stated that the company is taking time to deeply understand its operations in China and the competitive market landscape. The spokesperson indicated, "We are fully committed to our business and partners in China, as well as to the long-term development of the Chinese market. As stated during the Q4 earnings call, we are working to identify the best growth strategies, including exploring strategic partnerships." Starbucks wouldn't be the first Western company to sell a stake in its China business. Collaborating with local operators or investors is not uncommon when Western chains face competition from domestic brands or need to cater to local tastes. In 2016, Yum Brands, the parent company of KFC, sold part of its China business to Primavera Capital, a private equity firm. That business later spun off and became Yum China, which is now listed on the New York Stock Exchange. Similarly, McDonald's sold a majority stake in its mainland Chinese and Hong Kong operations to a group of investors in 2017, though it bought back some shares in 2023. Some commentators believe Starbucks is preparing to sell equity because of increasing pressure from domestic competitors like Luckin Coffee and Coty Coffee. With Luckin selling a cup of coffee for just 9.9 RMB and domestic demand waning, Starbucks appears to be setting up an exit strategy. China's coffee market has grown increasingly competitive in recent years. As of November 12th, the total number of coffee shops in China surpassed 200,000, with over 70,000 new shops opening in the past year and a net growth of 18,000 stores. However, Starbucks financial reports show declining performance. For the fourth fiscal quarter ending in September, Starbucks China reported net revenue of $783.7 million, a 6% sequential increase. But for the 2024 fiscal year, operating income in China fell to $3 billion, down 1.4% year-on-year. Same-store sales dropped 8%, with transaction volumes flat, while average ticket prices fell 8% due to frequent promotional activity. Starbucks opened its first store in China 25 years ago near Beijing's China World Trade Center. At the time, foreign businesses weren't allowed to operate restaurants independently, so Starbucks partnered with Beijing-made coffee to run the shop. A cappuccino cost around 19 RMB, about 5% of the average monthly income back then. Later, Starbucks entered joint ventures with other partners, one with Maxim's Group for Hong Kong and Guangdong, and another with Uni-President Enterprises for Shanghai and surrounding regions. After China began allowing foreign companies to fully own their businesses in 2004, Starbucks gradually acquired its local partners' shares. By the end of 2017, Starbucks had nearly 3,000 stores in China, opening one new store every 15 hours. It catered to a growing middle class eager for premium experiences. That year, China saw revenue in China and the Asia-Pacific grow by 10%, following a 23% increase the previous year. The momentum continued with 38% revenue growth in 2018 and 19% in 2019. By then, China was Starbucks' second largest market. However, the pandemic hit hard in 2020, forcing many stores to close. While Starbucks rebounded strongly in 2021 with a 42% revenue increase, the past 2 years have brought new challenges both in China and globally. In the most recent quarter, global same-store sales fell 7%, driven by a 14% decline in China. For the 12 months ending in September, Starbucks' total revenue reached $36.2 billion, with China contributing 9%. Starbucks' new CEO, Laxman Narasimhan, acknowledged during the latest earnings call that he needs to spend more time understanding the complexities of the Chinese market. The downturn in Starbucks China's performance has drawn attention from media and consumers alike. Emily, a Chinese student interviewed on August 1st, noted that Starbucks was once seen as a status symbol for white-collar workers in China. It evoked a sense of urban sophistication. However, this perception has faded. With increasing encouragement to support domestic products, consumers now prefer cheaper local coffee chains over Starbucks' far pricier offerings. Another Chinese student, Mr. Ye, shared that while he used to have extra money to spend on Starbucks or bubble tea with friends, such drinks are now considered luxury items by many. He pointed out that it's especially hard for young graduates to find paid internships or stable jobs, with some even having to pay for internship opportunities. He said, "Most of my classmates don't earn much. We've gone from occasionally enjoying Starbucks to settling for budget drinks like Mi Xue Bing Cheng. Now, even that feels out of reach." Economist Si Ling observed that Starbucks' struggles in China highlight deeper issues, including weakening middle-class spending power, rising unemployment among professionals, and a shrinking high-income demographic. This, he added, reflects a broader trend of economic contraction in China. Si Ling highlighted that large coffee chains, including Starbucks, employ significant numbers of young people, and their declining performance could exacerbate youth unemployment in China. Social media commentator Gong Zishen echoed the sentiment, linking Starbucks' struggles to China's worsening economic conditions and the resulting consumption downgrade. He noted, "The middle class is preoccupied with mortgage payments and child-rearing expenses, leaving little disposable income for non-essential items like coffee." This signals a shrinking market for such products in China. In recent years, promotions offering coffee for as low as 9.9 RMB have flooded the Chinese market, intensifying competition between domestic and international brands. Starbucks China CEO Liu Tsoi acknowledged that the frequent promotional environment has pressured the entire industry, impacting Starbucks' same-store sales. Despite these challenges, China remains Starbucks' second-largest market, with over 7,500 stores as of the end of September. Starbucks has a presence in over 1,000 counties across China. The company added a net 790 stores in the 2024 fiscal year, a 12% growth, marking a record high. In June, a viral topic on Chinese social media suggested that Starbucks had effectively joined the 9.9 RMB price war. More consumers noticed discounted prices on popular items like lattes and frappuccinos through delivery apps, sometimes as low as 10 to 20 RMB. By stacking exclusive coupons and promotions, some even secured Starbucks drinks for 9.9 RMB. Reports indicate that the Starbucks app now offers various limited-time deals, including 3 cups for 49.9 RMB, 2 cups for 39.9 RMB, and single-cup discounts for up to 30%. Many consumers noted receiving 5 or more discount coupons daily, with some humorously remarking that Starbucks sends me coupons every day. Starbucks China chairwoman and CEO Belinda Wong explained that the lower average ticket prices stemmed from personalized promotional activities aimed at increasing purchase frequency. She emphasized that this strategy helps optimize both sales and profits, signaling that trading price for volume has become Starbucks' strategy in China. Meanwhile, domestic brands like Luckin Coffee, Manner, and M-Stand have rapidly expanded, appealing to consumers with high-value offerings. Coffee, for instance, announced in May that it was prepared to run 9.9 RMB promotions for 3 years. By February 2024, Coffee's global store count reached 7,000, making it the third largest coffee chain in China, trailing only Luckin and Starbucks. As competition intensifies, even previously leading brands like Pacific Coffee face significant challenges. Pacific Coffee's mainland store count dropped by at least 114 locations between August 2023 and October 2024, leaving only 71 stores. Pacific Coffee has also seen a large number of closures in its stores in Guangdong. In the near future, it will close at least 10 stores in Zhuhai and Guangzhou. Pacific Coffee did not deny the rumors of a large number of store closures. According to Chinese media reports, the person in charge of Pacific Coffee responded on October 16th that in recent years, the Chinese coffee industry has encountered greater market competition and challenges, and the adjustment of the number of Pacific Coffee's mainland stores is a strategic and proactive choice. Pacific Coffee, founded in 1992 in Hong Kong by an American couple, was once a major player, rivaling Starbucks in the region. Acquired by state-owned China Resources in 2010, Pacific Coffee expanded into mainland China the following year. However, mounting market competition has forced it to scale back its mainland operations, with its recent closures concentrated in Guangdong Province. A company representative stated on October 16th that the adjustments reflect a strategic decision in response to the intense market challenges. The coffee market in China has become a battlefield for both international and domestic players, with low-priced promotions driving consumer preferences. While Starbucks once dominated the premium segment, the rise of budget-friendly domestic brands and changing economic conditions have transformed the landscape. Now, even Starbucks is forced to adapt. As the industry continues to evolve, it remains to be seen how global and local brands will navigate the increasingly crowded and competitive market. Pacific Coffee, once a leader in China's coffee market, initially focused on premium coffee offerings in major cities like Beijing, Shanghai, Guangzhou, and Shenzhen. Its products were priced around 30 RMB per customer, targeting business professionals. By 2015, Pacific Coffee had become the second-largest coffee brand in China, trailing only Starbucks. However, after 3 years of pandemic restrictions, the brand began significantly closing stores by the end of 2022. Reports in 2023 suggested that Pacific Coffee might be sold. In contrast, Seesaw Coffee, one of China's earliest specialty coffee chains, has faced even more severe challenges. The company experienced serious financial difficulties, with founder Wu Xiaomei being placed under restrictions for high consumption. Seesaw was also reported to have owed back wages to employees and debts to suppliers. Seesaw, founded in 2012, was the first specialty coffee brand in China to secure investment, raising 45 million RMB in 2017. It continued to attract capital investments in 2021 and 2022, with a store valuation 100 million RMB. Founder Wu Xiaomei set ambitious expansion targets, aiming for 500 to 1,000 stores over the next 5 years. However, the company has struggled with cash flow, and its expansion plans have faltered. Severe difficulties are not limited to coffee chains. The broader restaurant industry in China has also been hit hard by economic slowdowns and declining consumer sentiment. Data shows that over 1 million restaurants closed in the first half of 2024, a sharp increase from the previous year, with projections suggesting more than 2 million closures by year-end. Several well-known restaurant chains, including the Japanese chain Akasaka Tei and various local eateries, have also shut down. One bakery owner, for example, admitted that the financial pressure had become unbearable. The report said that if the statistical time is extended, the number of brands that have fallen will be countless. In the eyes of many people in the industry, the wave of bankruptcies has just begun. The catering industry is seriously oversupplied, and a large number of restaurants will collapse. News on social platforms shows that numerous hot pot restaurants, Chinese restaurants, pubs, etc. have collapsed. For example, Luckin Coffee in Beijing quietly closed its store in October. Based on the current situation of the industry, these 4 types of stores will be eliminated first. 1. Large stores with high rent and poor efficiency. 2. Stores with intensive services and high labor costs. 3. Internet celebrity stores that come and go in a flurry. 4. Stores that rely too much on marketing. The report mentioned that rent, labor, and ingredients are the 3 big mountains of restaurant operating costs. The bigger the store and the higher the rent, the higher the requirements for cash flow. Once the business is not as good as expected and there's a cash outflow problem, rent becomes an issue and the store will have to be closed. The person in charge of a high-end Western restaurant said that the waiters must not only speak proficient English, but also participate in food and wine training and assessment. The monthly salary is between 15,000 to 18,000, while the monthly salary of a sommelier is as high as 20,000. Some chef salaries are even higher. The average monthly labor cost in the restaurant alone is as high as 400,000 yuan. In addition, stores that rely on internet celebrities sometimes survive less than 1 month. Data from Meituan shows that among the stores that closed down in 2023, stores selling internet celebrity products accounted for 50%. In March of this year, a large number of Tianshui Malatang stores appeared across China. Some of the business owners spent 20,000 yuan to study in Gansu and then returned to Jinan and invested 200,000 to 300,000 yuan to open a store. They announced their closure 18 days after opening. The report said that if it only relies on marketing to gain customers without products that draw repeat business, it will be difficult for a store to become popular. Revenue will decrease, and the final outcome will be bankruptcy. Associate Professor Sun Guoxiang at the University of Nanhua in Taiwan believes that catering is actually a very important part of China's consumption, but consumers seem to be saving money, and the overall situation is that people's consumer confidence continues to collapse. He said the impact on the service sector could cause another, more severe wave of unemployment. This wave of unemployment in the service industry may extend to all aspects, such as food delivery. This means that China's economy has never been able to improve in terms of consumption and continues to move towards a more serious and deepening situation.